So welcome back to the Finance Value Guy. And in today's video, this is going to give you a guide on how you can trade options in the UK with a plus 500. If you've ever wondered how to trade options to potentially boost your trading profits, you're in the right place. So option trading can actually seem quite complex at first, but it's a versatile tool that allows you to speculate on market movements, hedge your positions, or simply diversify your trading strategies. And in this video, we'll demystify options trading, specifically focusing on how you can trade call and put options CFDs on the Plus 500 platform. I'm going to cover the essentials, what option CFDs are, and how they actually differ from the traditional options that are offered in the United States and other countries, and all of the steps that you need to get started. Now, Plus 500 offers an accessible way to trade options with no commissions, using CFDs to speculate on the price of calls and puts without the need for owning the underlying asset. So whether you're looking to capitalize on market trends or manage your risk, stick around and I'm going to show you guys everything. So right here, you can see we're in the Plus 500 menu. And basically, as we scroll down, you're going to be able to see these options. So if you scroll down to indices options, you can then see that there are many different options of the option. You can see that there are the UK 100. You can see that we've got the S&P 500, the US Tech 100, and we've got other countries too. And then we scroll down, we do have these shares options, which are essentially the top FANG stocks. And if we click these, we can see the recent change in these options and we can see if we would like to trade them. Now, currently the market is closed, but I'm going to get into some of the differences between the traditional options versus the actual CFDs that we're going to be using as options in today's video. The reason I'm going to be doing a quick explanation for this is because I do know that the majority of options that most people understand are the ones that are currently available in the United States. And because it's the UK, it's actually quite tricky to get your hands on some options. So understanding the differences between the two is going to be really important to understand what you're doing with your money. So one of the first things is the ownership and obligation. Traditional options give the buyer the right, but not the obligation to buy or sell the underlying asset at a specific strike price before the option's expiration. That means if you hold the option, you can choose to exercise it to buy, call, or sell, put the underlying asset. Now, with option CFDs, they are quite different. These do not confer any ownership rights or obligations over the underlying asset. Instead, you're speculating on the price movements of the options themselves. You only realize profit or loss based on the difference between the opening and closing price of the CFD. Now let's look at the differences between the execution and the settlement. In traditional options, these can be exercised for calls or puts to actually buy or sell the underlying asset. And the settlement can involve delivery of the actual asset or cash settlement. Now for the option CFDs, these cannot be exercised. They can be closed by taking the opposite position. Your profit or loss is based solely on the price difference, with no actual delivery or ownership of the underlying asset. As for commissions and fees, traditional options typically involve commissions or fees charged by brokers for trading and sometimes additional costs for exercising the options. But for option CFDs on Plus 500, these have no commissions, making them potentially cheaper to trade from a fee perspective, but spreads and other trading costs may apply. Now let's get into the leverage and risk. Traditional options, the leverage is intrinsic because you control a large amount of the underlying asset with a smaller investment, but your risk is generally limited to the premium paid. For option CFDs, this also involves leverage, which means that you can control large positions with relatively small capital. However, due to leverage, your potential losses can be larger compared to traditional options, especially if the underlying asset moves against your position significantly. Now, in terms of profit potential, for traditional options, when it comes to the profit and loss, the maximum loss is usually limited to the premium paid for buying the option. Profit can be substantial if the asset moves favorably. Now, for option CFDs, what we're going to be using today, they offer potentially higher profit due to the leverage, but also come with a higher significant risk of losses because of that same leverage. So in summary, the differences between these share some characteristics with traditional options, but they are fundamentally different because they are purely speculative instruments that don't grant any rights to the underlying asset and are typically subject to higher leverage and associated risks. So let's actually see how we can actually use these. So if we come back to this screen, we can pretty much select any stock that we want, and I'm going to select Nvidia stock right here. You can see that this Nvidia options has a variety of different values. Now, before I go onto the screen, I'm going to show you guys the actual price of Nvidia shares. So if we click right here, you can see that Nvidia shares are down 2%. So the first row right here actually shows the Nvidia stock price, or the Nvidia stock CFD, which is currently down 2.11%, with a sell price of $125.12. and a buy price of $126.06. This actually reflects the stock market's performance during the regular trading session, but it does not factor in any after-hour changes, such as a few after hours drops. Now, when we actually look at the options here, what we can currently see is that all the current call options, such as the call here, the call here, and the call here, and the ones below, are all showing a negative value, / a negative chain, reflecting that their value has dropped during the trading session. This decrease aligns with the stock's downwards movement, as call options typically lose value when the underlying asset price declines. So for example, if we think that something is going to decline, but unfortunately we bought a call option, that call option is going to lose value because the stock price fell. Now, for the put options, these CFDs actually replicate the price movement of put options, and these put options listed, such as the puts here, you can see the put 121 September, the one for September at 122, all the way up to 125. These show a significant positive change, which are around 15 to 16%. This is currently expected because put options gain value when the underlying stock price falls, providing a bearish hedge or speculative opportunity. So essentially what we have here is a situation where because Nvidia fell today, the put options gained value. Now, something that most people might be wondering is about the expiration. So let's actually take a look with the current call option and let's see how that works with expiration. So if we click this first one right here, we can click this one more time because it should pop up on the right hand side. We can wait for this data to process and we can now see the dates for this. So what you can see right here on my screen is of course the trade for the option. You can see what you want to pay attention to is this small area right here. You can see it says Nvidia SEP, which is September the 24th, and then C, which stands for call, and 121, which is the strike price. So essentially, this is a lot of data. I wish they kind of put it in a better way, but essentially this expires at September the 24th, which means that whether or not you're in profit or whether you're in a loss, whichever position that you have open will be closed and the position will be settled in cash. Now remember, you are speculating on the price of the option, which is not the stock, without actually taking delivery of the stock or the option. If the price of the underlying option rises, the value of your CFD rises and vice versa. Now, options are really useful because what they do is they allow you to get greater exposure to, I guess you could say, higher market returns, but that also exposes you to higher market losses. Now, Nvidia wasn't the only company that moved today. You can see that Netflix was down today, but of course, some people managed to make 40% by buying put options, which is quite unheard of unless you're going to be trading penny stocks, which is why some people do like these kind of CFDs, because it does allow you to gain a huge exposure to different assets in terms of the percentage gain. If you are just buying the underlying stock outright, a 1% move here and there isn't going to drastically change your portfolio. But for those looking to advance their portfolio with risky bets, options provides a way to do that. Now, Netflix CFD options are showing extreme changes, which does suggest that the implied volatility for Netflix options are higher, and this essentially causes the option prices to react more dramatically to movements in underlying stock price, even if the stock movement itself is quite small. Now, the larger swings in the Netflix option CFDs could also indicate higher gamma, which makes the options more sensitive to the underlying price change, especially as the stock moves closer to the strike price. Now, for beginners, there are strategies that you can use in order to gain money from these CFD options. Of course, you can buy calls or puts. So for example, what you could do, if you do believe that by the time this contract expires, it's going to keep going down, you could buy this asset or the CFD. And of course, you would gain a percentage base from that due to the increase of the option value. Or if you think the price is going to reverse and it's actually going to start going up towards whichever value you think's right here, you can then of course buy a call option. If you think Netflix is going to move from its current value and actually move upwards, you can buy any of the call options and you're going to gain some gains there. Now, this is just the very, very basic method, but of course, there are other advanced option strategies